what are we going to do today? We are going to talk about one concept, which is dependence. Now, this is very important because if you recall, when we defined an HOH, which was an important status, when we defined an HOH, we did refer to the concept of who is a dependent child and who is a dependent relative. Okay, so we are going to talk about the concept of what is dependency. And if you recall in yesterday's class, I gave you a history of the dependency, right? So we spoke about the fact that there was something called personal exemptions that was relevant before the Donald Trump government came into power. But post the Tax Cut and Jobs Act, we did away with personal exemptions. But we still retaining. What are these dependents? How do you say that a child is a dependent on you? How do you say that your parents are dependent on you? What if I have a parent who's studying in a nursing, who's staying in a nursing home, but let's say that parent is having a lot of money or earning a lot of money, and that parent actually is not requiring my support. Can I still claim that parent is my relative? So here we are going to talk about the concept of who can be qualified as a dependent on your return. Again, what is the relevance for three things? First, an HOH is a very important status, but that HOH status can only be claimed for somebody who has a dependent. That's number one. Second, there are certain credits like child tax credit, like earned income credit. Uh, so these are some of the credits. We're going to talk about it more when we're going to go to those sessions. But there are some credits which are dependent, where you need a dependent child or a dependent relative to qualify for that credit. It's the reason why we are studying this. Okay, so who are dependents and how do you categorize them as dependent? Now, this is a confusing area, guys, because we have a big question that sim today that we're going to solve. But essentially, these are areas which are a little confusing because the questions that you may get is how many dependents do I have? One, two, four. So these are areas where that again that objective approach is very important. You should exactly know why you are calling somebody as a dependent and why you're not calling somebody as a dependent. So we are going to talk about three concepts today. We are going to talk about who's a dependent. So who qualifies as a dependent? That's the first concept. This is something which is not directly tested in CPA, but it's important because if there is somebody who's having an unearned income. So if you recall, we spoke about this when we discussed. So remember this slide that we had in the last section where we said who's supposed to be filing the returns, and we said that if there is a dependent. So the third one, if you remember, if there is a dependent with a gross income greater than standard deduction or with an unearned income greater than 1250, we need to file our return, right? So we are going to define who is a dependent with unearned income greater than $1,250. So this is basically continuation of that thought, even though I don't see a lot of direct questions coming from here in the exam, but I still think that somehow the learning is incomplete if you've not done that earlier. Okay, so we are going to discuss that, but in really short, and I'll give you just one example in this, but not for testing, but for understanding purposes. And then what we're going to do is we're going to give you an overview of entire Form 1040. So it's basically like I'm giving you a drone kind of a view or a macro view, a 30,000 feet view of all the schedules, all the forms that we are going to study. And my suggestion is that should be your yardstick. So let's talk about the first concept, which is who are dependents. Okay, two things. Either somebody has to be a qualifying child. Now, see, the definition of child, as we were talking about yesterday, is a little wide in the in the US parlance. And at the same time, if you look at the type of questions that are asked in the CPA exam, they are not going to go extremely critical about defining a child. So you will never get a question like who is a child and who is not a child. They will give you this is a qualifying, this is a child. So your job is going to be to understand whether that child meets the criteria for the qualifying child. So if I break down the question into two parts, who is defined as a child? And the second thing is, what does the child have to? So what qualifies that child to be a dependent? So if I talk about it in the two different situations, the definition of child is not tested much in the CPA exam. But the criteria for qualifying that child is one that you've got to be really careful about. Okay. So, what is a child? So, there are two things. Either somebody is your child, and second, somebody is not directly your child, a relative. So, how do you say that either one of you, them, is a dependent for whom you can either claim an HOH status or for whom you can claim credits under your earned income credit, child and dependent credit? So, who is that dependent? Okay. Now, for a qualifying child, there has to be certain criteria that you have to meet. First, that child has to stay in the same house as that of the taxpayer for more than half of the taxable year. And the child cannot file a joint return with somebody else. So it cannot be that you've got a child and the child gets married and the child files a joint return with somebody else. That cannot be the case. So first, that you should have the same residency as that of the child for more than half of the taxable year. It's the first criteria. The next criteria, the child should be less than 19 years of age. We can extend it to 24 years provided that child is a full-time student in an educational institution that has a full-time student situation. And second, if that child is permanently disabled, then we are not going to give any criteria of age as far as the child is concerned in order to qualify as a qualifying child. So simple. First, that child has to stay with you for more than half of the tax year. Second, that child has to be less than 19. And so less than 19 means the child has just got into college. So if you're a college dropout, we'll keep it as 19 years. If you are proceeding ahead with your college education, we'll wait for the time till you complete your college education. A question will come that came yesterday. Ritika, if you remember, you asked me this question: what if the child is staying in a hostel? What if the child is staying in a dorm? So yes, the child can stay in a hostel and a dorm and will still qualify as a dependent child, provided the address or communication, for all practical purposes, you have a home which is his permanent address to come back to at the time when he's staying in the or she's staying in the hostel. Another thing that you need to know here is when you say 24 years and a full time student, all that we need in a year is at least some way or the other 5 months of participation in the college, attendance or participation in the college. So, what do you mean by that? Let's look at a situation where the person is finally qualifying from a college and leaving. So, January, February, March, these are the 3 months in which the child is going to the college. January, February, March, 3 months, the child is going to the college. April is a off. May is the final ceremony where you're going to, give that certificate and everything to the child. So as far as IRS is concerned, IRS knows that till May, you are on the roll of the college. Even for one day, if you attend the college in the month of May, that will still qualify you as a criteria for a full-time student of that year. But remember, any part of any of the 5 months of a taxable year will qualify you as a full-time student in that college. Okay, so two things. First, are residency. More than half of the year, the child has to stay with you. Second, age criteria, less than 19 or 24 if full-time student. Third criteria, close relative. So who is the child? The child would be your child. It could be your brother, could be your sister, could be the child of the brother or a sister. So anybody in your linear descendant will become your close relative. So they're very open with the definition of close relative. Could be a kid, your child, younger brother, younger sister, their children, everybody would be regarded as children. Okay, now see, this has a history. What was the history? I'll tell you. Two things here. One is eliminate the gross income test, and second is the support list. Now, see, imagine a situation where you have, Will Smith's son. I forgot his name. Whatever. At the time when he did Karate Kid, let's say he got a lot of money. Okay, and that child was still staying with the dad. Yeah, I'm very bad with the names, guys. Okay, I'm very bad with the names. So I'll give you the reference, but you've got to fix up the dots, right? So imagine you're a child actor or you're a child player. In both the situations, you're earning a lot of money. And with that money, but you're still staying with your dad. You're still staying in the dad house, and the dad is providing for your education, for your vacations. Everything is being provided by the dad. So we say that, see, just because the child is earning a lot of money does not mean that the child is not your child and that child is not dependent on you. So long as you are, he is staying with you and he is still sharing the residency as you, I would still say that you can go ahead and claim the child on your return as a dependent. So I don't care how much money is that child making and whether that money is taxable or non-taxable. So if it's a child, the earning is immaterial. And the second thing is the support test. Now, see, there was a time when they used to say that, see, the child should not provide, you should provide more than 50% of the child's support. But then they rephrased the wordings and they said that no, what we would say is the child should not provide more than half of his own support. That means when you say support, what do you mean by support? Support typically means education, vacation. So it depends on what is the social status of the child. Okay, just you have a child artist who's earning really well. Probably a good vacation is a support for that child. So this is a kind of a gray area in the US law because the support depends on the circumstances of the child. We cannot say that we have a minimum level support and that should be for all the children. No. So there are 5 criterias. If the child races through all of them, that child becomes a qualified child. Same house as yours, less than 19 years or 24, if he or she is a full-time student, closely related to you, your son, grandson, your children, brother, sister, their children. The child's income is irrelevant. Whether that is taxable, non taxable, nothing matters. Okay. Last, the child should not provide more than half of his or her own support. If all the criteria are being met, we would say the child is a qualifying child. Is it clear? Then we go to relative. Who becomes a qualifying relative for you? Okay. Who becomes a qualifying relative for you? So, who becomes a qualifying relative? Okay. Who becomes a qualifying relative? The first, that person should not file a joint return. Obviously, that's the first thing, right? If you are taking somebody's ITIN number and putting it on your return, that ITIN number cannot be used in anybody else's return unless and until it is only for claiming refund. So, who becomes a qualifying relative? A qualifying relative is first cannot have a separate return. Must be the claimant only on your return. That's the first thing. Second, must only be citizens of or residents of US, Canada, or Mexico. So you cannot have people who are not citizens or residents. So you cannot have somebody in India who can be claimed as a relative for you sitting in the US. You cannot have that. Okay, you cannot adopt a child in Africa, in Sudan, and then you say that I'm paying for that child, so that child becomes my relative. You cannot have that. Third, now, this is important. Either that relative, so if that person is related to you, either that relative, so first is either that person has to be related to you. That's the first thing. Or if that person is not related to you, then that person has to stay with you for the whole year. And here, when they say cousins, they're not meaning your brother's children, they are meaning your father's brother's children. Okay, and somebody raised this question earlier. So this is what I was referring even earlier when the term cousins was being met. Okay, so it is not somebody who is your blood directly, but somebody who's your father's friend and father's brothers and their children. Those are termed as cousins. So remember, not cousins and foster parents. So if I merge the two concepts, in HOH, if there's a relative, that relative has to stay with you for more than half of the year. But if there is a person who is not related to you, that person comes and for you, that person you are paying. So the example was the boyfriend, the girlfriend, my friend. If that person comes and stays with me for the entire year in the US, my house is that person's house. And I'm providing for the support of that person, then that person has to stay with me for the whole year. So either that person is related to you in some way or the other, or that person is not related to you but stays with you for the entire year. Okay. But can that person be somebody for whom you can claim an HOH status? The answer is no. No HOH status. Even though that person can be claimed as a dependent, but that person cannot let you have the HOH status. Is this clear? Anirban, is this clear? So that confusion about half year, full year, is this clear now, guys? If it's a relative and for HOH, more than half of the year would do. But if it's a qualifying relative, and if that person is not a relative, then that person has to stay with you for the entire year for you to claim that person as a qualifying relative. But in that case, that person cannot help you get an HOH status. So P precludes filing of joint return. O, only citizens of US, Mexico, Canada. Either that person is related to you in some way or the other, or that person stays with you for the entire tax year. That person cannot have a taxable income of greater than $4,700, because in that case, that person can go and file their own return. Okay. Now remember, any kind of non-taxable income, is allowed. Now see, in India also, if you look at it, there are certain securities for which you want people to go and invest, right? In the US, that kind of a security is US government, US state bonds, US municipal bonds, not federal bonds. Remember, okay? So for US state and municipal bonds, if you are investing and if you are earning any interest, that interest is exempt from tax purposes. So if let's say I have a father or a mother who's filthy rich, and but that person is staying in a nursing home or a care, doesn't want to come and stay with me. But at the same time, that person was smart enough to go and invest all the life savings in state bonds or municipal bonds. Now, in that case, that person may be making a lot of money. At the end of the day, all of that money is outside the tax net. And hence, I can still go and claim that person as my qualifying relative. So please remember, what is important is the taxable income should not be more than $4,700. Now, this is an indexed figure which keeps changing. I hope for all of you guys, we stick to this figure and we complete our paper. Okay. So the tax, remember, any amount of non-taxable income. So some, social security benefits, scholarships, some of these would be tax-free. So the amount of taxable income being made by the relative should be below a threshold limit. And the last S, which is you must have provided more than half of the support of the person. Now, can you see the difference between the two wordings? Okay. So earlier this was the same, but then they said no. Whatever you're providing is immaterial. What I'm interested in is the child should not go and provide more than half of his or her support. But for a qualifying relative, somebody who's coming and staying with you for the entire year or for more than half of the year, it's important that you are providing more than half of the support of the person. Okay. So when I say support, what it means? I mean whatever is required to sustain that person in the US. So if that person is studying, the tuition fees, if that person is training, the training fees, food, clothing, whatever is the requirement for maintaining that person, that becomes the support. But you remember when we were doing HOH, we spoke about maintenance of home. We said that for that person, you're maintaining a home for more than half of the taxable year. Maintenance of home is different. Support is different. Maintenance of home means paying for the insurance, municipal taxes, and all of that for that property. Support of the person means maintaining that person in the US, ensuring that person can survive in the US. So, two definitions: qualifying child, qualifying relative, either of them. And my suggestion is follow it on the basis of acronyms. You get a question, you have got to be very alert, because what my suggestion is, for every situation, write down the acronym and then tick, tick, tick. Okay, this is done, this is done, this is done. CRACES, done. The child is a qualifying child. Quote us, done. The child is a qualifying relative. If no, if any of the facets above that we are talking about is not met, then that person becomes that person isn't either a qualifying child or a qualifying relative. That person is not a dependent on you. That's it. Okay. Certain things that I want you to keep in mind. One second. Yeah. Another thing is, for everybody, for each of these people whom you're claiming as a relative, there must be a distinct identification number. For somebody who's in the US, get an SSN number. For somebody who's not a US citizen or a green card holder and you're not eligible for an SSN, get an individual tax identification number. Without that, because you need to quote that in your form 1040. Okay, so that unique number should be there for that child. Okay, couple of things. This is what we just spoke about. Why are we still talking about dependents when the personal exemptions have been completely removed? You still need them for the HOH status. Okay, that's number one. And second, credits like child tax credit and dependent care credit and earned income credits will not be possible for you if you do not have the dependence definition, because these credits define the dependents for whom you can get the credits. Okay. If the parents, okay, this is very, very important, guys. Understand this. See, if the parents of the child are entitled to claim the child, so I have a child and that child I can claim as dependent on my return. But let's say that child is earning a lot of money. He becomes a hacker and he starts earning a lot of money. And I say, okay, let him be. I don't want to claim him as a dependent. I don't want to earn off him. So I don't claim that child as a dependent. Please remember that child cannot be claimed as a dependent under anybody's return unless and until we can substantiate that that person is earning more than the highest earning parent. Okay, so this is important. If I have a child who's earning a lot, and if I choose to let go of claiming that child as my dependent, now when I'm saying this in your mind, you should have one SSN. For an IRS, you are just an SSN number, right? For an IRS, it says, okay, the parent did not claim. Why did somebody else come and claim that guy as a dependent? So it's very important that the savings of tax cannot be more than what it would be for a person who is legally entitled to claim that as a benefit. So if the child is not claiming, if the parent is not claiming a child as a dependent, anybody else who's claiming has to substantiate that that amount of money is more than what, or in other words, the savings would not have been more. Okay, so that's the first thing. Who is the definite? So how do you define child? Child includes daughter, son, stepdaughter, brother, sister, stepbrother, stepsister, or a descendant of any of these. It has to be in your in your line, okay, in your progeny. It cannot be with somebody else's family tree. Ketki, is it okay? Chalo, I've done it for you. But this is never asked, okay? Never, ever I've seen a question where they will define, they'll ask you, okay, this is a situation, is that person a child? No, they'll say, this is a child. Now tell me, is he qualifying the racist criteria or not? Okay. Okay, child will also include a legally adopted child or a child lawfully placed with the taxpayer for legal adoption, and it will include a foster child. Okay, there was only one situation in which foster child was not included, guys. So I think it's a good idea to keep that in mind. I think we did it yesterday, right? It was, I think, as qualifying surviving spouse. This is the only situation where a foster child will not be allowed. Okay, so just remember this in your mind. Don't try to remember it for every situation. Just remember, for a QSS, a foster child will not be included. For all the others, foster child is generally included as a part of your definition of child. Okay, so this will include foster child, legally adopted child. It will include all kind of children. Okay. If you talk about a qualifying relative could be a parent, could be a child, could be a sibling. Now, why we're talking about the sibling here? Sibling could be a child also. Okay, sibling could be defined as a child also. So it depends. That relative could be somebody, but again, when we say relative, we are again going on in your progeny. We are not going into somebody else's family tree. How do you define support? Support. Now, see, this is important, guys. Okay, don't confuse maintenance of home with support. Okay, support, you mean economic support, money, items, amount of money spent on items such as food, clothing, shelter, medical care, dental care, medical insurance, education, child care, vacations, depend. So remember, the support, the definition is dependent on the social hierarchy of the child, of what is it that the child is into. Okay, so for somebody who's training to be a tennis star, that amount of money that is being spent on that child, that's support for the training, maybe a lot of money. Then we go to something which is called multiple support agreement. Now, what is multiple? I'll first give you an example. Now, let's say there are so we are three brothers and sisters. Okay, so let's say three of us stay in the US, three of us are very close knit, and we have only one parent who's remaining. One of a parent is not there. Okay, let's not talk about me. Let's talk about X. X has three siblings. Now, out of the three siblings who are all staying in the US, there is one dependent father. Okay, now that dependent father is old, staying in a nursing home. And that dependent father, what we are doing is three of them. So let's say A, B, and C. All three of them are providing for the support of that dependent father. And since it's a close knit family, all of them are well settled. Each one of them is, let's say, providing one third support of the dependent father. Okay? So all of them together are providing a support for a father. The question is, who will claim that? Let's say, uh, now put numbers into it. Let's say $30,000 is being spent for the dad's stay in that nursing home on a yearly basis. Each of the three siblings are paying $10,000 each. The question is, can each of them claim $10,000 and say that, see, that person is one third dependent on me and I will pay a support of, let's say, 10,000. So the proportionate support will be given to me. Can we do that? The question is, we're defining the dependent. Dependent is one person. Dependent cannot be half a person or one third person, right? So what to do? So what you can do is, you cannot split that person in one third, okay? You can split your tax savings year on year. That means A or B or C can take turns. In year one, A will define that parent as a dependent. In year B, B will define. In year C, C will define. May happen. But at the same time, what you could do is this. Each one of them, so one of them can claim the full tax savings. And then there is a form. That form, you can say that I'm splitting that savings with my other two people. It means I get all and then I split it depending on the proportion that is being spent on the other two. And the other two can also sign their consent and give it to A. So you cannot break that, you cannot divide that person in one third or one half, but you can split the savings into one third or one fourth or one half as the case may be. But even in that situation, we have laid down some ground rules. Okay, I don't want it to be so minute that so when I say I'm always IRS. Okay, so I don't want, because see, at the end of the day, I have to monitor everything, right? And tax laws are not easy. So at the end of the day, there should be some control. So what I say is very simple. What I say is three things. There has to be more than two people. So all of this tension and headache is worth it if only I'm having at least two or more people. Second, all of them should ideally be in a position to qualify that father as a dependent relative. Because if that is not there, then the next question doesn't arise. And the third is, each one of them, okay, I think I'll take the fourth one also here. Yeah. So see, it is like this, that each one of them must provide at least 10% support and none of them can provide greater than 50% support. Now, why is this last one important? If anybody is providing more than half of the support, I will not go and give any credit to anybody else. You are providing more than half of the support, you claim the person is your dependent, you get all the tax credit related to that person. Period. Nothing else is needed. So the first criteria is, no one should be qualifying enough to say that that person is my qualifying relative and providing more than 50% support, chapter closed. So the question will come only when none of them are providing more than 50% support. Then we go to the next level. What is the next level? It should be big enough that I'm even going to consider you. So at least you provide 10% support. Okay, so these are the two broad categories that we're going to get into. Each one of them would otherwise be entitled to call that father as a dependent relative. Second, each one of them should at least provide 10% support. If these two are being met, then we say, okay, overall, none of them should provide more than 50% support. If all the three conditions are met, then we go ahead and say, okay, you can claim that person as a relative, but only one person can claim, and the others, there is a way in which we can legalize the entire thing. So the joint contributors are required to file a multiple support declaration. You have to let the IRS know that we are providing multiple support for this defendant. And there's a form 2120. Okay. The execution of this is not within the scope of CPA syllabus. They are going to question you only on whether a multiple support is valid. Who can claim that person is a dependent? How will that dependency be claimed? What should be there in form 2120? What amount? That portion is not tested in the CPA exam. Okay. So let's go to the basics of who can claim that person as a dependent. Okay. Let's take a question here. Tony lives single, lives in California, has no income, supported in full by the following three people. Okay, so there is this old, so this he is the old dad in our example. Okay, he's the old dad in our example. He lives in California. That means he's not staying with anybody. Okay, and his support is being provided by three people. Jack, who's an unrelated friend, providing 48% of the support. Peter, who's the brother, providing 43% of the support. Martha, who's the daughter, providing 9% support. What's the answer? So Jack goes out. Martha goes out because the support is less than 9%. So if it's less
Yeah,
than
right,
10%, I'm
right.
not going to talk about it. So the only person who's left is Peter. Is it clear? So please remember, if somebody is
Yes.
related to you, then only. So if Peter, so for Martha, if Martha would have provided 42%, it would be okay, because Martha's dad need not stay with you, and Martha could also get a HOH status. You never know, right? But then for her to get an HOH status, she should have provided more than 50% of the support, which is not happening. Okay. But remember, unrelated friend must be staying with you for the full year. That's not happening. Hence, Jack goes away. Is this clear? So if you have a divorced parent situation, who is a person who can get the dependency of the child in his or her return? Again, please remember, these are the rules which we've undergone a change over a period of time. There was a time when they were concentrating a lot on the AGI of the parent, and they used to say whoever has a higher AGI, that person can claim the dependent. But then they realized that no, in real life, the person who's actually taking care of the child needs most of the support. So for one part, IRS became less selfish. We said, okay, let us just be the providers rather than seekers. We're not worried about our money, we're worried about the support of the children. So we said, see, it doesn't matter who's earning how much. It doesn't matter how much support is being provided to the child by whom. What matters is who is taking care of the child, who is there with the child for more than half of the year. That parent is called the custodial parent, with whom the child is staying for more than half of the year. It doesn't matter what does divorce decree say. So you can sign a contract saying that I'm going to claim that person as the dependent. No. IRS says I'm just going to look into the facts of the case. Is the child simply going and staying with you during summer vacations and weekends? Or is the child actually staying with spouse B the time when it's more than half of the tax year? So whoever has greater custody gets to claim the child as his or her dependent. Okay? And I'm maybe a situation that there's a parent who's sick, or there's a parent who's not earning and still taking care of the child. So I'm not going to be bothered about how much support is being provided. So I don't want somebody to just throw money, not take care of the child, and still get the dependency deduction. I don't want that. Okay. So whoever, so period, whoever has greater custody gets to claim the child as a dependent on his or her return. But what if they have equal custody? What if now that victim situation is no longer in the picture? If they have equal custody, that anybody who has a greater AGI gets to claim the child on his or her return. Okay, so remember, first I look at the victim concept. Whoever has greater custody, forget about the support. But if you have equal custody, then I know both of them are equal. Doesn't matter. Then I don't have to think about the sufferer and the suffered. Simply go whoever has a higher AGI. So I'm going to roll back to my selfish self the moment it becomes equal custody. Okay. Okay, these are not easy questions, guys. Okay. Now see, I could have taken 2, 3, 4 MCQs. It would have still served the same purpose. Okay, so my job, guys, is not to teach you an MCQ or to teach you a sim. And this is my sincere suggestion. Don't chase the type of question. Chase the concept. If your concept is clear, I can ask you. See, I had a student. I still have a student who's writing his FAR exam today. And I remember a couple of days back, he freaked out and he messaged me that, I'm suddenly thinking that they're going to take 2 or 3 chapters, mix them together, and they're going to ask you. And my suggestion was, why are you thinking that you will not be asked like this? So don't chase the type of question. Don't chase, okay, this will have 5 more questions. Because see, if I am a CPA, AICPA, so every time when I'm a student and I'm facing a question, I always position myself on the other side. Now imagine there are a lot of people who are wanting to be CPAs. So how do I eliminate them? I'm going to look, see, remember always, even in real life, guys, when you go and ask yourself, or when you even go for interviews, nobody wants the technical details. People want the fact that your fundamentals are solid or not. Work on your fundamentals, build up your concepts. The moment your concept is built up, forget it, move ahead. Doesn't matter whether you solve 2 questions, 5 questions, 10 questions. You are clear about every single concept, move ahead. Have that ability that even if there are 30 materials available to me, I'm not going to go and look for all those 30 materials. Chase concepts. After that, I can mix dependence with this, with that, with anything. If my concepts are clear, I can interlink the topics. Okay, so first individual topics, then merge the topics and have that expectation that I'm going to have a paper where everything will be mixed together and I will be able to handle it. Okay? So let's do this question and let's see. So this is, I would say it's a little a difficult question because here you have to say how many dependents am I going to have? One dependent, two dependent, five dependents, how many? Okay. So for each item below, please indicate the number of people who meet the definition of a dependent as either a qualifying child or a qualifying relative. So my sincere suggestion is when you have a question like this, and I do follow acronyms for things that I find are really, I used to remember there was a very stupid paper, MICS book paper in CA, where they just asked you what are the characteristics of this system, what are the, all of those, which was rote learning, not concept based. It really works wonders if you have acronyms. So individual taxation is an area where I would be using a lot of acronyms, more than what probably some of the content providers would give, because that helps me understand the full concepts and retain it in my mind. Okay. So I will say for a qualifying child races, for a qualifying relative, I have quotas. Okay. So for each of them, I'll just tick, cross, tick, cross. If all are ticks, I know it's a relative. So the first question, I want all of you to attempt this in the chat panel. Okay. B is single, supports 3 dogs. He has no other dependents. Okay, this is an easy one. But why was it there in the question? We are slowly going towards a culture where pets are becoming like family. People are very emotional about their pets. Okay, I have known people who have kind of that uh, that they have what show that burial of the pet was at their place. They put up a marble thing, and after that, they could never have another pet. There are offices now who would allow the pets to come to you, right? So please remember, pets are everything is okay, but yeah, pet parents. It's a big industry in India at the moment. It's stage, and I had a friend of mine who moved to US, and she said, Shraddha, it is so much easier to just have a pet rather than a child. You don't have to train a pet to eat. Just throw him food, he will eat. Why would I have a child, work so hard, and then train the child and all of that? Not needed. Have a pet, gives you all the care, love, and also would die in 14 years. You don't have to worry about that pet. I know it's not a very good thing to say, but what I'm saying is, I know you can be very attached, treat a pet as a child, but still for IRS, that pet is a pet. No dependency exemption. Next, M is single, fully supports her 22-year-old daughter. Now, please be very alert. These are not easy questions, okay? M is single, fully supports a 22-year-old daughter who's a full-time college student who graduated in May. April, Jan, Feb, March, April, May. 5 months done, qualifies. J earned $5,000 by working part-time jobs during the year. J lived in a dorm until she graduated, then lived with M the rest of the year. Do you get a dependency exemption? If it was 4700 criteria would have been applicable to the child, then the child would not have qualified because you're above the 4700 threshold. For a child, it's not important how much money is that child making. What is important is the C, the A, the R, the A, the C, the E, and the S. Residency, yes, for more than half of the year the child is staying with you. Age, yes, the child is less than 24 and a full-time student. Yes, a very close relative because that child is your child. E does not matter how much money, eliminates the gross income test, does not matter how much money the child is making. Okay, the third one now. A and J are married and file a joint return. They provide 100% support for their 5-year-old son P, and A's father B, who has no income, lives alone in a separate house purchased by A and J. How many? How many guys? Everybody? Okay, let's look at it one by one. If it is a child, the child is staying with you. less than 19 years of age, yes, closely related. I don't care how much money is he making. And yes, the child is not providing more than his or her support. So yes, B would qualify. Let's talk about the dad now. For the dad, either, so what was the thing? It is PORTUS. Okay. The dad is not filing a joint return. Yes, dad is staying in the US. Yes, he's a relative to me because he's my dad. I don't care because he's not other taxpayer, so it's not relevant. Dad is not having any income, and I'm providing more than 50% of my dad's support. So even that would qualify. Go slow, guys, okay? Please follow a system. I don't want you to rush and take a, because these are not easy questions. If you're, if I ask you the same question and I have to do it only for your dad, you will be able to answer. But when I have to mention the number of dependents, it makes it difficult. So go slow and answer your questions. Okay, so the answer is two and not one. Okay, the fourth one now. D and M are married, file a joint return. D's fraternity brother from college, Mark, lived with them for the entire year. Mark earned $6,000 from odd jobs during the year and is supported more than 50% by D and M. So definitely not a qualifying child. Let's look at the criteria for qualifying relative. So we have what? We have PORTUS. Is there a joint return? No, this information is not given. You're going to assume that that's not there. Okay.
Not yet.
Uh, no, mute yourself. Mute yourself. So we'll say, okay, is he related to you? Okay, only citizen of US. Assume that person is a citizen of US. Nothing is related to you. So unless and until they tell you something which makes you believe that no, that person is not in the US, you're going to assume that person is in the US. Okay, so let's say this is there, this is there. Is he related to you? The answer is no, because that person is a fraternity brother. Is he staying with you for the entire year? The answer is yes, that person is staying with me for the entire year. Is that person earning less than 4,700 of taxable money? The answer is no. The person earned $6,000 and there is no reason for me to believe that that was not taxable. So this criteria is not being met because you're earning more than the prescribed $4,700. I will not go to the next criteria. This criteria not met, the answer is zero. Is this clear? Okay, the fifth one now. D and M are married, file a joint return. D's fraternity brother from college, Mark, lived with them for the entire year, has no income, and is supported. Now everything is going to be met, and the answer becomes one. Now everything is going to be met. Why? Because now the income is not there. That was the only thing which was not there. Support is also more than 50%, hence the answer becomes one. So take these three together. If you're able to understand this, you've understood the concept of qualifying relative. J is single, supports of three children. K is age 4 in preschool. S is 20 years and lives away from home but at the college. S has no income and maintains his mother's house as his permanent address. T is 25 years of age in the medical school, earns $10,000 in wages during the year. Both S and T are full-time students. How many number of dependents can I claim? How many number of dependents can I claim? Now see, all the three are children. So I don't have to go for qualifying relative. I will go only for C, the R, the A, the C, the E, and the S. Okay. So for the first one, everything is meeting. For the next one, everything is meeting. Even though that person is away in a college, but the primary residence is mine. But the last one, everything else is meeting, but you are 25 years of age. That's wrong because that has to be less than 24 years. Okay. This is immaterial, guys. This is a distractor. Please understand. Because if you're a child, it does not matter how much money you're making, provided you're less than 19 or less than 24 years of age. So it's only because the A criteria is not being met that I'm going to deny T the resident, the dependent status for me. Hence, the answer becomes 2. What I'm going to talk about right now is something which is going to be relevant for the next I think eight or nine more sessions. Okay. I'm going a little slow, guys, because you guys are getting a hang of the subject. I don't want to rush. And I definitely want you guys to follow all the M. So now with what we've covered today, definitely one of the units becomes completely in your hand. You can go ahead and do all the MCQs and the sims in that area, and then you can be ready for the next one. Okay. Okay, now what we're going to do next, you don't get a direct question from there, but I think it's so important because it's like, without this it's very difficult for me to take you to the next concept. So what we're going to do now is I'm going to discuss the entire form. So basically what we're going to talk about is after today. Okay, before the form, let me first talk to you about the concept. Okay, let's do that first. So when I calculate individual taxes in the US, what is it that we actually do? So how, oh, sorry. I think there's another concept that I missed out. Okay, this is a small one. Unfortunately, none of the study materials or it's not a part of the CPA syllabus. For reg, what I'm not very happy is what they do in the reg syllabus in the US, in the CPA, I'm saying. They've just taken bit, where whatever they felt was good enough to make your fundamentals and they've left the others to the extent that there are pockets in your understanding. Okay. So they've used the word dependence, unearned income, especially when you go to standard deduction, you will see this. Okay. Now we've already explained the concept of kiddie tax to you, right? So what they're trying to tell you is if there is a dependent, and what is my fear? My fear is it should not be that somebody who's earning a lot, one sec. My fear is it should not be if that's somebody who's earning a lot of money. I am going to siphon off my earnings in the name of my child. Let that child earn passive income. And then say, see, it's a child, and then that child will not file the return, and that escapes the tax net. In order to prevent that, I've introduced something called kiddie tax. What is the kiddie tax? Now, see, when we're talking about a dependent, what we are more concerned about is the unearned income. I'm not bothered about the earned income. So if there's a child who drops out of school at the age of, let's say, in class 7 or 8 or 9, whatever, and then that child goes and starts flipping burgers in McDonald's and start earning money. And he's not there in the college, but he's having a steady life. And to the extent that he also goes and starts investing in the IRA accounts, you will see that IRS has gone ahead and given a tax savings to that person. You will get an additional credit. And if that person is actually going and investing in the IRA, your retirement accounts, you will see that he will be applauded by the IRS. What I'm worried about is parents acting smart and siphoning off their funds in the name of the children. Because that is something that I don't want, because that's a money that escapes the tax net. So what we say is whenever there is a dependent who is having an unearned, basically interest, maybe dividends, okay, all of these money when it is being generated by somebody who's dependent on you, for whom you're providing more than 50% support. In that case, I say that there would be a kiddie tax. What would be the kiddie tax? Ideally, that person should be like a qualifying child of yours, greater than less than 19 or 24, full-time student. And if there is a net unearned income or the passive income of the child, which is really high, that means I'll define what is high. But if that is really high, then I'm going to let that child file the return. So this is not the parent filing the return. We let the child file the return, but pay tax, which would be at a rate which the parent would have paid had that income been reported in the parent's return. Now that's termed as a kiddie tax. So in India, we say clubbing of income. In India, we say that if the child is earning a passive income, we club it into the parent's return and we let the parents pay. IRS is very clear. No, I will let the tax rate be equal to the dad's or the mother's rate, but it will be taxed in the child's name as a kiddie tax. Okay. Obviously, this is the amount that nobody calculates and does it. This is the amount that IRS will come and tell you that this is the amount you have underpaid. Okay, and with the penalty, of course. So how would you calculate the net unearned income of the child? Now, this is not for your CPA syllabus. It's just for your information because they're going to use these terms and it's important for you to understand what these terms are. Okay. So what they say, you find out the passive income and you deduct a 1250, which is kind of a standard deduction that you give for a child. Also another amount, which is either 1250 or If you've spent certain amount to earn that unearned income, we take the higher that amount. So I don't want you to get into this specifics. Again, this is an amount that changes every year. But what they're trying to tell you is at least double of your standard deduction. Okay. So for a person who is claimed as a dependent on your return, the highest standard deduction that you get is either 1250 or the amount that you're earning plus $400. You remember we had this $400 as self-employment amount. We said that if anybody is self-employed and earning more than $400, we want you to file your income tax return. Okay. So here, it's the same concept coming in. Whatever you're earning, you add $400 to it or 1250, whichever is greater. That becomes the standard deduction for a dependent. And whenever there is an unearned income, I will give you at least twice of 1250 as a deduction. Can be more than that. Okay. So there's a very small question I have here. Just, and I've given you the answer for this also, just to get a visual of how it works. Okay. Because they're going to use these terms later in standard deduction and you'll be completely lost. Khan, who is a dependent child of 5 years, had $4,950 of unearned income and did not have any earned income. So obviously, it's a dad or a mother who's siphoning off their funds in his name. So how much of this income would be subject to kiddie tax? The total unearned income is $4,950. I'll give you at least double of the standard deduction at the minimum that is applicable for you, which is $1,250. And the balance money that is there will be taxed at parents' marginal tax rate in the hands of the child. And this is termed as kiddie tax. The child pays the tax. So poor child, even before he's 5 years of age here, he has a tarnished IRS history. Okay. So I told you yesterday, right, that in the US, it's not a bad idea to go through somebody's IRS returns before signing up the paper. Why? Because you would not want to have an injured or an innocent spouse thing. So that's the reason why married filing separately concept is also there. Anyways, it's not used much, but it's still there. Okay. Okay. Now I want you to take you through the concept, okay, of when I say that you will have to book your taxes, you have to show your taxes. What is the entire gamut, right? So what we are going to do is we are going to show you a map, and then from tomorrow onwards, we are going to take you to one area of the map and take it in detail. Now think of it like a Disneyland tour. I tell you from gate 1 to gate 2, this is what you have to do. These are the different areas. These are the water slides. This is this slide. This is that slide. And then tomorrow we'll go to each of these areas. But today I want to give you an overview and I want to connect it with the form so that you exactly know, okay, this is a form that I'm going to do today. This is a form that I'm going to do tomorrow. And ultimately how it is going to tie up on your main mother form, which is form 1040. Okay. So what do you do first? You first let the IRS know how much money is in your possession. Remember, it doesn't matter whether you've earned that money, you've not earned that money. You just got that money lying on the floor. You got that money illegally. Legally, I don't bother. If you get $1 on the US soil, now you know what is US soil, right? Whether it's worldwide income or US source income, it's immaterial. But either if it is worldwide or it is US source, depending on whether you have met the green card test, substantial presence test. So tie up that, right? So the moment you get $1 on the US soil or anywhere if you're chargeable for a worldwide income, then that amount needs to be reported to the IRS theoretically. That becomes a part of gross income. So in tomorrow's session, and probably I'll take one more session because that's a big topic. We are going to decode what comes as gross income. So what is taxable, what is non-taxable, what is partially taxable. We are going to discuss gross income in great details. After the gross income, so what I'll do, I'll give you a big bucket and I'll say put everything in that bucket. Why? Because I am IRS and I want to know how much dollar was earned in the US soil. Now, whether you can take it out or not, that's different. But right now, imagine there's a big bucket and I want you to pour everything in that big bucket. Whether it is legal, whether it is illegal, whether it is earned, whether it is earned, whether it is unearned, anything. You won a lottery, you looted somebody, you ran a big scandal for drugs, whatever you did, you report everything. You put that in that bucket. And then After that, now I will give you some valid reasons to avoid the taxes. That's the reason it's called tax avoidance. I'm giving you legal means because that is how the economic policies of a nation is being built, right? Uh, so now I want to steer the expense of the community of the entire US fraternity in a particular direction. Hence, I will give you the first set of deductions. We will call them adjustments. Now, this could be anything, right? I am going to call them adjustments. Now, here, what I give you is an exhaustive list. You cannot go beyond what I have given you, right? Say, for instance, student loan. If you're paying student loan, there's an interest on that. I will let you take that interest as a deduction. Why? Because I want people to study. Okay, so like that, there are some IRA. If you're saving money for retirement, I let you save a part of that money spent in the form of adjustments. So I've given you a big list. Again, my suggestion is go by acronyms. When we are going to do adjustments, we are going to go with that acronym 1, 2, 3, 4, 5. I think there are some 11 or 10 items there. We're going to crack each one of them. So it's very simple, plain, vanilla, simple. I go to a list. I understand how are they giving me that adjustment. And then I go and I apply that. Now, here, when I look at adjustments, I have a list of, let's say, 11 items. It doesn't matter whether all 11 are there, one is there, five is there, two is there. These are independent items. I have any one, two, or all. You can take all of them, but only within the periphery set. So it has been defined by IRS. If you have student loan interest till this amount, you can take that, provided the loan is in your name. So all that I need to know is the provision. The day I do the provision, I know my answer is there. These are also termed as above the line deduction. Now, why is the line defined? I'm going to tell you that also. So I take everything in the bucket and then I give you a tab. I call the first tab adjustments or above the line deductions. So whatever you could take out. So this tab has 11 holes or 10 holes, whatever that list is. With that list, and that hole will open only if you meet certain criteria. You meet that criteria, that hole opens. Is that hole dependent on the others? The answer is no. There are 11 holes. Any one of them it is met, all of them met, you will be able to drain that income out and not pay tax on it. So when you get a deduction, you save taxes. Then after that, there is a line which they define. And why is that line defined? The line is defined because that is the way I'm going to strategize and I'm going to demarcate. Okay. And I'm going to put everybody in the US into buckets. You are rich, you are very rich, you are poor. Why do I do that? Now, see, these are not terms that IRS defines. This is what I think in my mind, but I don't say. Okay. So when I go to the appraisal meeting, I come up and say everything is okay. But in my mind, I'm thinking, why am I wasting my time? So this is what I'm thinking, but I'm not saying. So what I do, I take the gross income, I reduce all the adjustments, and then IRS will look at me and say, oh, this is the guy I have to keep track on. He's super rich. Oh, he's a guy who's on the journey of becoming super rich. Oh, he's a poor chap. Let me give him, because my attitude towards that person will change on the basis of AGI. Okay, to give you an example, in India, we have this subsidy, right? What is the subsidy? If you are ordering these LPG cylinders at home, you have a subsidy. But then they tell you if you're earning more than 10 lakhs in a year, then I don't think you need the subsidy. I will roll out that subsidy for you. Why? Because you don't need it. Let it be. So in India, I don't know whether it has been legalized or not. We are still asking. Are you more than having 10 lakhs, more than 10 lakhs? Okay, then you submit a form and I will remove the subsidy and you will have to pay us a full amount. But in the US, what they do is this. They have put you under categories and depending on what category you have. So if you're really poor, I'll give you a lot of incentive. The moment you become a little rich, I will start rolling back the incentives. Now you don't need my support in retiring savings. Now you don't need my support in education. Now you don't need my support in this, that. And then there is a super rich category where I will say you will not need any incentive. You're so rich. Why will I give you any incentive to save taxes? You should pay me money, right? So what is AGI? It's a very important threshold because that is the threshold by which I define. So IRS is going to look you through that lens. That's the result. That's the result. That's the reason why a lot of incentives later, a lot of credits you will see, I will roll out on the basis of AGI. So there's another term that they're going to use. It's called modified AGI. Sometimes what they do is They will modify. So, what is your gross income? Less adjustments. They will also make some changes in the AGI. They will call it modified AGI. Okay, the gift of Magi. You, I don't know. Um, okay, so there was a very hilarious Guju boy with us when we were doing our internship with. So he used to say that when these guys came to Jesus, what if these guys would have been Gujus? It would have been called gift of Gujai. And they would get khapras and theplas and all of that instead of the Frankenstein and the mir and all. Okay. So MAGI, Magi, right? So we had gross income, less adjustments, and then the AGI. AGI is a very important threshold, guys, because the AGI will determine what incentives you will get and what you want. Once you have the AGI, then you have two separate things. Okay. One is either I will give you a standard deduction. So I am removing all of the others. Okay. So, okay. So now we have that limit. I have already set you a particular way, and now I know with which lens I have to look at you. Then I go to two deductions. Now, after the AGI, that means after you have taken all the above. So everything in IRS is above the line or below the line. After I've taken above the line deductions, now I come below the line. And here I give you a choice. What is that choice? Either you get a standard flat rate. Now you remember when we were talking about personal exemptions day before yesterday, I told you that before the Tax Cut and Jobs Act, this amount was really less. And what we had instead of this was something called personal exemptions. So if I have five brothers and sisters, and if all of them moved with me to the US, and each of them have only one child, so I have 10 dependents. For 10, I will have some fixed amount of personal exemption. And the more dependents I have, the better it is for me because I get a tax reduction. Now, this underwent a change with the Donald Trump government because this guy came and said, no, America has become a hotbed for all the immigrants and they are all coming and robbing us of the American jobs. First thing is, there is nothing called America. You were a melting pot of all the different cultures. Now, who gave you the right to say that these are the ones who should be there on the soil and these are the ones who should not be there on the soil? You go and you build up a big wall. I mean, I don't know which age are you staying in, saying that all the Mexican will come. There are research which says that, for people, when they stop the Mexican laborers being employed in the US, what you realized was that with time, so what they did, there were a lot of Mexican laborers who were being employed. And then all of this drama happened and Mexican laborers stopped coming. Did that job go to the Americans? The research said no. Once people are used to small amount of or savings, they will never go back to the original. They changed the method of farming to more mechanized farming. So ultimately, that job did not come back to Americans. That job did not occur in the world. That job vanished. So there's no point, when your people have to break walls rather than build walls now, right? So what we said, now forget about personal exemption. I give you a big amount. And that big amount does not depend upon whether you have 5 heads or 10 heads. Forget, no economic benefits out of these 5 heads or 10 heads. So what do we have? Either, so this went off, completely gone. Now what do we have? Now we have two things. So think of it like this. There is a big whale. Okay? So there's a big whale. That big whale is, let's say, a standard deduction. So what I can do is either I can give you this big one, which is standard deduction, or I can give you a lot of these small fishes, which will not have any sense if they are not in a group. So it's either a big whale or a horde of these small fishes working together, but all of them are applicable only if you pitch all of them together and match them with the whale. If so, what is the small ones? The small ones are called itemized deduction. So I give you a lot of these extra stuff, and all of that extra stuff has to be bundled together. And then you're going to match it against the bigger one, which is a standard deduction. And now it is up to you. You want to take the easier, more convenient standard deduction, or if you're a tax expert and you think you can manage everything, go and take the smaller ones all spread across and then pitch them up against the standard deduction. Whichever is higher, take that and bunk the other. And now here, match this with the concept of marriage filing separately. If there is a couple who would have been able to file a married filing jointly couple, but they both choose to go and file married filing separately, Can one take standard deduction and other take itemized deduction? The answer is no. We say no, you cannot get the best of both the worlds. Either both itemize or both take standard deduction. Cannot be one you, one you. You cannot do that. So that is another problem with the married filing separately status. That you will have to go with what the person is saying. You cannot take separate ones, even though economically the separate choice may make more sense. So what I do at one end of the spectrum, I put the standard deduction, which is a very simple thing, flat rate. I don't want to substantiate anything. And on the other side of the spectrum, I put the itemized deduction, which is like a Dhobi list of a lot of small things. Again, for you, I know this sounds very good right now and very romantic, but for you, it is a lot of work because you will have to mug up. And what they'll do is they're going to see, let's take medical deductions. That is itemized deduction. That is not adjustment. They will ask you, is it adjustment? Is it my itemized deduction? So you have to exactly know what comes above the line, what comes below the line. Okay. And that is why acronyms work wonders here. If you don't have it by the content provider, I will give you one. And after that, if you want to make your own acronyms, you can do that. And thankfully, IRS has mercy on us because earlier they used to have something called miscellaneous itemized deduction. That means itemized deduction, one of these dots will again blow up and will have all of these sub branches, and then we will call them miscellaneous, for which you will get a 2% slab. Thank goodness they did away with this. So this is no longer there. So remember, any answer choice that mentions miscellaneous itemized deduction is a wrong answer choice because that does not exist anymore, thankfully for us. Okay, so remember, if anything says miscellaneous itemized deduction, we are not going to talk about it at all. Okay, so what do? We have gross income, less adjustments, gives you AGI. And then below that, you can either go the easy route and take a standard deduction, or you can go a complex route, take a lot of those Dhobi lists that has been given to you. But none of them matter individually, guys. All of them would matter. Like I'll tell you, taxes. That's an itemized deduction. Medical deductions, an itemized deduction. So none of these fishes have any relevance on their own. So if I remove all of them, one fish is meaningless. But they will have sense when I take all of them together and then I match them against the standard deduction. So remember, for adjustments, I don't care if the others are there or not. I have these 11 holes, each of them is applicable. But for itemized deduction, you cannot have any relevance till all of them are taken together. Individually, they have no existence. Together, they can stand and be a match in relation to standard deduction. Okay? So then we will learn a big Dhobi list of what are the items which are itemized deduction. So we start with gross income, give you the first level of deductions called adjustments, also called below the line above the line adjustments. Then we look at that AGI where I feel IRS is kind of judging me. And then I look down and say, okay, it's either a standard deduction, typically if you want a really hassle-free return, or it's an itemized deduction, whichever is high automatically. Now, this used to be the case a couple of years back. But then something drastic happened in the US, Tax Cut and Jobs Act. Also, what it did was suddenly they reduced the taxes on the corporates. Now, what is a flow through entity? In India, partnership has a separate status. Partnership. So let's say we have two people here. Let's say we have Anirban and Arjun. Anirban and Arjun qualify. They make a partnership. क्या करेंगे? They will sell something that both of them really like and they feel there is a value for it in the market. So they make a partnership. They file an agreement which is either an LLP or a general partnership. Okay? So they make that partnership agreement. Who pays taxes? The partnership pays taxes. Okay, so partnership pays taxes and then they each get a share of their money from there. But in the US, that does not work. In the US, you're either a big fry or you're a small fry. If you're a small fry, you don't matter. So what do we say? We say in the US, you are just a conduit. So how will a partnership be taxed in the US? A partnership is a conduit. So when IRS is concerned, IRS says, boss, you just give me an idea of what was the earning. But the money actually flows through to Anirban and Arjun. These are the two people. If you were supposed to form the same partnership in the US, let's say you earn $100. Partnership will file a return called file return 1065, which is just an information return. So what the IRS is saying, hey, you are there, you just let me know whether I can keep a watchdog on the other two. So 1065 is just an information return that lets them know that, see, I made 100. And then this 100, let's say they're splitting their income in 50 is to 50. And 100 will get split into 50-50, and each one of them will report $50 where? On their form 1040, and then pay tax on that in their individual form 1040. In other words, your marginal tax rate is 37%. So you're penalizing companies to be a partnership or an LLP or a sole proprietorship in the US. It cannot work because US economy is totally based on, all on the new technology where people would want some kind of a protection. So what you had to do was, in order to put the other forms of business at bay with corporate form of business, you introduced a deduction, and that deduction is called a qualified business income deduction. So that deduction is called a QBI deduction. So that's a deduction that is applicable only if you are a flow through business entity. You can get as much as 20%. So this is a complicated topic, guys. Okay, we'll talk about it. So this looks really good, I know. But when you look at the details, you need to know the full, and then each one of them you just decode. So individual taxation, the beauty is all you have to do is first time effort and then just keeping the provision in your mind. If you can do that, individual taxation is sorted and you get 100% of the marks. Regulation is the most scoring paper in the entire CPA syllabus, guys. Okay. But how you put in the effort is important. Okay. So then we had this QBI deduction. For all those flow through business entities, if your business is earning money, I will make you eligible for an extra 20% deduction. But they have made it so complicated. For a normal person to think of taking this deduction is a nightmare. You have to go and talk to a TP, maybe a CPA or an EA or an attorney, and then you need to work this out for you because definitely the calculation of QBI is beyond the scope of any normal person. So we will talk about, and QBI is tested in details in the CPA exam, guys. Okay. So then that's the next layer of deduction. Once you get all of this, what now comes is the taxable income. So that's the first concept. You will take gross income, reduce the adjustments, get the AGI, get either the standard or the itemized, whichever is higher. And then the last deduction is the QBI deduction for flow through business entities. That gives you the taxable income. Now you're going to use the graded tax structure rates depending on your filing status, whether you are an individual who's a single individual or a QSS or a married filing jointly or a head of household or a married filing separate, whom I will not look properly. If I'm the IRS, I'll be like really angry when I see a MFS return. After that, then we have, so my suggestion is when you look at federal income tax, you also add all the other taxes here. Okay. So, 1 second. Yeah, 1 second. Yeah. So what are the other taxes that will come up? The other taxes will be something like a social security tax, like a tax on early withdrawal of IRA account. So these are some extra taxes that will be leviable above your federal income tax, right? Now, AMT has been abolished in your syllabus. It's no longer there, but there was this concept. Can anybody tell me what is the basic premise of an AMT? Do we want to reduce the taxes or do we want to even out the taxes over a period of time? What is the concept of AMT, guys? Do we want to reduce the taxes or do we want to have an even taxes over a period of time? Take out more taxes. Carsten, that's a very vague statement. What do you mean by saying take out more taxes? No, that's not the right answer. We don't want the incomes to be given in a very haphazard, 1 year too much, another year down, another year too much, another year down. We don't want that. We want the taxes to be paid evenly. So in 1 year, if you're paying very less, and that payment is less because you have taken the advantages of all the tax deductions that I've given you, I will roll back those deductions and I will calculate a minimum amount that I have to pay as taxes. In the next year, if my regular tax is more, then only I can adjust the last year's taxes. The idea is not to reduce the taxes, The idea is to ensure that there is some amount of consistency in your tax payments. Okay? Yeah, there is some amount of, it does not, because your overall tax incidence will not increase. You will always have an AMT credit, but you can't use it against the AMT tax. You can use it only against the regular tax. But the best part is it is outside the scope of your syllabus now. We're not going to do take a detailed dig at it. So what technically, I will arrive at my taxable income, apply the tax slab rates. Okay, so basically my uh, taxable income into your slab rates depending on my filing status will give me my federal income tax, and I will just make sure that I'm giving at least a bare minimum tax in any year. So there typically what we are doing is we are rolling back the tax exemptions given. Then we will arrive at at least the minimum amount that I feel you should be making every year, because you have been able to reduce the taxes only because of the deductions that I have given you. After this, I will add up all the other taxes like a social security, your IRA withdrawals, all of that. If there's extra tax, I will pile it up. After that, I can give you another round of deductions, which are termed as tax credits. Okay. So this is the full thing. And what is the last item, which is payments? These are everything that you have. So basically in India, we call them as TDS, tax deducted at source. If people have deducted tax at source for you, when you're finally determining how much tax is due or how much tax needs to be refunded to you, you knock all of that off against your income tax liability after considering your tax credits. So you deduct all of it, and then in the end, what you get is either the tax that you have to pay to the IRS or the refund that you're going to get from there. Is this clear, everybody? Because now I'm just going to tie it up with the various forms. Okay. We are going to restrict ourselves to these forms. But yeah, my suggestion is that you need to know the form numbers, guys. Okay. You need to know the form numbers. Because for IRS, and if you want to even start practicing at any point of time, all that you are going to be identified with is the form number that you can file up. So see, this is the master form, which is form 1040. Now this is that standard deduction. Can you see this? This area here is standard deduction. So you have gross income, less adjustments or above the line deductions. Then you get AGI. From the AGI, you can either deduct your standard deduction or itemized deduction, whichever is higher. So this is your standard deduction. This is the area where we've defined the relatives for you, right? So who is your dependent, either a qualifying. So we've already completed this and this. These are the two parts that we have already completed. Okay. So we have defined the filing status. We have discussed the dependents.